So good day, good morning. Hope you had a fantastic weekend, an opportunity to unwind and rebalance your life. But it's a Monday, which means we got to get ready for the week. We need to set some traps for our pips. It's 7:30 in the morning, Wall Street time, approximately London lunch. It's the 20th of April, 2015, Monday morning. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that allows you to trade Forex, energies, metals, indices, binary options, all that jazz. So today, we are going to cover the news calendar and look at the risk events for the week. We're also going to go over the Commitment of Traders report. And we'll get our satellite realigned, timed. So it should be a good trading day. If we have any time left over, we'll do some technical analysis. What do you stink? Smell like a plan? Now let me remind you that trading and investing is risky and not appropriate for everyone. Your past performance, good or bad, does not predict future results. So please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. All right, so let's take a quick look around the world here. British pound is strong, euro is weak, Swiss franc is neutral, Japanese yen is fairly strong, dollar is quite strong, Aussie is quite strong, CAD is quite strong, Kiwi is quite strong. So commodity currencies around the world have been doing pretty good overnight. Pound recovering, still bouncing off that area from last week. More cuts from China. Excuse me. More cuts from China on the reserve requirement ratio. And what impact, since you brought that up, what impact on money supply does that have? Yes, more money, the supply increases. Excuse me. Got a frog in my throat this morning. Yeah, does anyone know the money multiplier formula? To figure out exactly how much money? Yeah. Yeah, 1 over R plus E. Yeah, okay, it's like 1 over blah, blah, blah. 1 over the required reserve ratio plus the excess reserves. Yeah. So anyways. La, 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 la. So anyways, money supply goes up. Oh, yeah. Brings interest rates down. All right, so let's move forward here. Start with the economic calendar. Lots of RBA stuff already. We have Pelosi speaking. Is that right? I didn't know that. I didn't even look at the calendar yet. What's he talking about? Well, anyways, looks like we're going to start off with Canada first. But really what was on my mind is the Reserve Bank of Australia. Gee whiz. Me. The RBA, monetary meeting minutes and all that kind of stuff. Lots of RBA stuff right off the back. So I'm thinking Aussie. Oi, 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 oi. So that's the big mover, but looks like Pelosi is going to speak today. Wonder where that is. Blah, it doesn't say anything. All right, fine. So central banking stuff, Could move the market. But the median minutes are really interesting because we're wondering if Australia is going to cut interest rates further. That's what's on the mind of the market. We know the floor that they've said is around 75, or sorry, is 75. We hit that and bounced. It just floated our way up to 78.5 and maybe just work our way down to 75 again. So we're going to pay very close attention to what Governor Stevens says at the Reserve Bank of Australia. Followed up by CPI. So lots of things going on right off the bat. To start the week, you should be trading the Aussie dollar. German zoo is going to be important. We just want to see if quantitative easing is having any impact whatsoever. And then we're going to learn what the Bank of England is thinking and what they're discussing at their meetings. So British pound, very, 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 very important this week. And last week, the British pound did stabilize, as we guessed, 6 to 8 weeks later. So it's very interesting. You have to kind of plan now, like even though it's bounced, you can't just buy when it's high. I think it's going to, we're up at this 150 level again, and it's psychological. I wouldn't be surprised if we saw a hesitation or a pullback around the 150 area. So let's just be careful around 150, 149, that kind of stuff. But once this Bank of England meeting minutes come out, then we're going to feel a lot more confident on direction one way or the other. So that could be a game changer. That could really confirm the short-term bullishness we've had out of the Bank of England. Okay, so that'll be a very good thing. So pay a lot of attention to that. And then going back to the Aussie, we're going to have manufacturing data out of China. This is on the 23rd now. So what is that, Wednesday? Yeah, Wednesday. So that'll go back to the Australia. So right off the bat, like a lot of commodity currencies this week should be moving, right? Which is typical when you get like PMI week, where it's like PMI. Guess what? Commodity currencies tend to move. Jenny from the block wants to know when to buy the cable. Well, last week we said around the 15th. So it's more like when time and not when in price. We also had an inverse head and shoulders designed and set up, I think, right? I'm just going from memory. So the first idea was, we've already set it up. It's already been traded. So now what you end up doing is buying dips. I'm not sure if we have it set up on any of these charts. I might have to kind of look around. Oh yeah, there it is. So we've already predicted this. Okay, we've already played this out. We're at the top range. So, I would play psychological levels and like that, but you can see we're on top of the wedge. Okay. So here this bottom area was the buy zone, and then it did the inverse head and shoulders pattern, which we had set up before it occurred. Went up to the next level, so it just moved quite quickly up into here. And so now it'd be like, typical technical analysis would say, buy off the 21, which happens to be a psych level. Okay, now that's pretty generic stuff, right? So what you need to do is, now that we're in this area near the 21, and this is 4 hours, so this could be over the next 12 hours. You might want to look for technical reversal patterns on smaller time frames near 149. And what you're doing is you're catching the drop. Okay. Another way of looking at it is you could take this top to that bottom and look for the reverse fib the other way. But, you know, I'm going to play this area, you know, this 149 area like I already have marked up. And just, you know, like just look for reversal patterns. Okay? Does that make sense, Jen? Yeah, cool. Okay, now obviously the meeting minutes and stuff can throw a wrench into any plan. So, you know, last week's plan worked out even better than we hoped. So now it's like you get to the 150 psychological level, and you know it's going to have an impact. What kind of impact? Well, I don't really know. So now you have to reset it up, right? So you do the technical analysis. Here we are around 140. Sure, if a reversal pattern on a 15-minute takes place, sure you could long there, drop a stop. But by the time we get to Wednesday, all bets are off. But ideally, they come out and they don't say anything negative, which would be positive. Because that's the side the risk is on this equation, right? So if they don't say anything negative, that's going to be positive, and all of a sudden we find ourselves at 155 by Friday, right? And you'll say, oh yeah, I got in at 149. Here we are at, you know, yeah. So anyways. PMI, retail sales out of the UK. So that's all good, right? That's all good. So I'd start out with commodity currencies, then start, filtering in some pound. And then, you just get your weekly unemployment, jobless claims. That's fine. That's on trend. That's good. Stupid National Bank. The National Bank of Stupid. The SNB. I don't even want to look at that. And then we end the week. Durable goods. Durable goods is really a volatile event for various reasons, and I don't really take it that much as a indicator of the health of the economy because it's so jumpy. But the way I do look at it is I look at durable goods in relation to the housing market. So the housing market is much larger than the stock market in terms of money, and it's important to the economy. Now imagine that. But it's I don't know, it's many trillions of dollars a year. So if the housing market's good, people are buying houses, and what do? They buy new stainless steel appliances. And that'll come up in the durable goods. So if people are buying homes, that means the economy is functioning, they have a job, they have credit is available, credit is flowing, credit is affordable. Not only are they buying a house, but they're putting stainless steel appliances on their Home Depot credit card. So it all works, right? It's all working, baby. So, but you want to look at the longer term trend for durable goods versus just some one-off thing. Okay. Jen, impossible to say right now. Jen wants to know where would we end at the end of the week? Well, it depends. Depends where. Let's say you're a bull and you say to yourself you believe it's going to end the week higher, but right now it's fallen almost 100 pips. So I can't tell you where it's going to be until I know where the floor is, right? Where the bottom of the week is. So that's where like pivot points would come in, Jen. So if we found that support for the British pound this week would happen to be around, let's say, a weekly M2, then my target's going to be weekly M4. And if the MPC stuff comes out good, then I'm probably going to look at the higher, more aggressive target, which would be R2. But we haven't established that yet, so I can't give you a target if we haven't picked out a bottom yet. Okay, because it could fall all week and never go up. So we haven't established that. So I can't, until we've established a bottom as a bull, I can't tell you where the bears, where the target for the bullish trade is because, well, we're not in a bullish trade. Okay. All right. So, here's the thing, guys. Some good RBA stuff for the Australian dollar, right? So keep your eyes on that. Lots of good news out of the UK, so keep your eyes on the British pound. And everything else is just sort of, a normal week. And that's interesting because the market should move. It should move in a healthy way. There should be trends should develop and continue without too much volatility. And that's a good thing because volatility is risk. So I think we'll have a market that moves. Aussie could be volatile. Pound could be more volatile relative to the others. But the trends in play are probably going to stay in play in that direction, right? Okay. Jen asks another good question. Is the engulfing weekly candle of a reversal bullish? Yeah, maybe. I work on fundamentals. I love technical analysis, but much smaller time frames than weekly. And again, probably 8 weeks before it occurred, we said the middle of April, the British pound had a wonderful opportunity to reverse. That's fundamental. So we're talking 8 weeks before it happened, and then it actually happened. So you say, is the weekly engulfing candle a mark of a reversal? Well, yeah, I guess. I mean, it's already reversed, and we already knew it was going to reverse well before that. So the candle is just leftovers, right? So bullish, if you want that as your reversal indicator, sure, I use the IMF report. So now that you have it, then just like any engulfing candle, you would fib the candle, right? So just, basic everyday technical analysis, right? No big deal. So I do that on a weekly basis. I use weekly pivot points for that, Jen. It just makes it easy. All right, so like what? Okay, instead of a fib, let's change the chart here. Oh, this is perfect, in fact. Let me clean this up. So this is where I use pivot points, Jen. So there's 2 ways you can do this. You can use Fibonacci, right? And you measure the high to the low, and it does things like gives you a 3A2, a 50%, and a 618. Okay? And so you could fib it, and there's your buy zone, somewhere between the 3A2 and 618. Okay, 50% being 50% of the range. Now, pivot points, not that much different, but what they look at is the high, the low, the close, and they divide it by 3, so it's a weighted average. So notice where the weekly central pivot point is. Okay, let me draw it again now. Instead of using an average, which is the high, low, close divided by 2, sorry, a high and low divided by 2, that's the 50% right there. Okay, that's an average. Now, pivot points use a weighted average to take in end of week sentiment. So it's high, low, close divided by 3, and you get the weekly central, which is here, which says, which shows you or represents a bullish sentiment based on last week's price action, right? The week closed with a bullish sentiment, and that you should long here, which is really, let's call it a 3A2 instead of a 50%. So there's the middle of last week, and here's the weighted middle of last week. So just very basic technical analysis would be Okay, like that. Okay, Jen? Oui? See? Aye? Yeah, hey, anytime. Okay, all right, so let's do some commitment of traders stuff. So again, this report looks at large institutional positions in the market. They're not opinions, it's not sentiment, it's actual positions in the market. And the positions are so large. Arigato! Thank you, Wyatt. Hi. Yeah, the positions are so large that they're required by the US government to be reported. Holy smokes, huh? Can you imagine? So it's a big deal, right? It's real money. So what we're looking at is really a trend in smart money, because what we do is we filter out hedgers, because if you're a hedger, there are various reasons why you need to tell the government that you're participating in the market, but not for profit. There's probably even tax and costs and all these different things. To be a hedger, it's probably way better, but you need to report it, right? So anyways, so we filter out hedgers that are in the market doing the opposite, and then you can out of the total volume in the market, you can also filter out non-reportable. I mean, you see the total volume, right? You know who's reporting as hedging, who's reporting as non-hedging, and then the leftover is total, the rest of the volume, which, you know, by deduction is small money, or sometimes known as dumb money. And who's the dumb money? That's you and I, my friend. Oh boy. Yeah, we're dumb money because we're speculators and we're in non-reportable positions. So you can really figure out what's going on in the market by using this report. So again, this is non-hedging, non-dumb money, so you could call it smart money. Large institutional investors that are in the market only to make a profit. Yeah, sure, Oren, yes. Oren brings up a good point. These are reportable to U.S. authorities, so they're futures contracts, okay? Futures contracts traded on an exchange in the United States of America. But it's, you know, I might not be a smart man. Hey, Wyatt's getting his Forrest Gump accent down pretty good. So anyways, it's useful information. The downside to it is this is the information as of Tuesday of last week. It is reported Friday after the close of the market, so you can get it just a few days after. But again, this isn't going to place you into immediate trade, but very often I use these reports to tell me if a change in direction in current prices is likely to be a change in trend or not. That's the biggest use for me, right? So for example, the British pound has been strong this week, right, over the last, you know, several days, and we guessed that based on fundamentals that around the middle of last week, the British pound would go from bearish to bullish. It did. We're not going to see it in this data because this is the data as of Tuesday, and I think it just started then. So the next commitment of traders report, if we see a giant change in pound shorts and pound longs, then we could say it's not just a pullback, but a reversal. Okay? Because very often we'll see, like euro, you'll see that the whole market was net short, and and then all of a sudden for a week, the euro's strong, and you can see there's a whole bunch of people not in their short positions anymore, but nobody went long. So you could say, okay, well, it's not a reversal because we didn't get a dramatic change from those who are short to those, and then suddenly they're long. If you see everyone was short, and now there's less short, but no change in the longs, then we can say it's just a pullback based on profit taking, not a reversal in trend, and therefore we would sell high into the prevailing trend. Okay, so that's how I use it. It's a trend confirmation based on actual reportable positions by smart money. It's worth our time, right? Don't you think? We should do this every Monday morning? It doesn't take too much time, but I think it's pretty. So anyways, this is the euro. The red line is the price of the euro USD, so you can see the trend is down. The black line is the net. So what you do is you add all the long positions and all the short positions, and the difference is reported by the net line, which is black. So the trend is we've been net short the euro, which simply means many more people are short the euro than long. And then each one of these little dots represents a week. So I'm really looking at this last month here. And, people are still quite short, but we're not getting shorter, right? Am I to be concerned? Well, that's why we break these apart. So let's see. Over time, this sort of orange line represents those who are short. So we had some people getting out of their short positions, and then last week it actually stabilized. Okay. Now this is what I was talking about before. You see, let's say for about 3 weeks in a row, there was a pretty reasonable amount of people getting out of their short. This is when we were at like 105, right? 104, getting pretty close to parity. And all of a sudden, for 3 weeks in a row, there were less and less people short. Did they go long during that period? No, in fact, there was less and less people long. So you could tell here it's profit taking. Less people short, but even less, more or less, more or less people long. So in this situation, you say sell euro high, because there's no change in trend, just profit taking. So now you can see week over week, a few people went long, but just as many people went short, and very little change in the net. So sort of like neutral trend. So if I were me, I would continue shorting with a vengeance. Sell, sell, sell! Fire for effect. All right? And this helps confirm my own delusion. Yes. The question is, does this represent a particular currency that the euro's, in this case, falling against? Yes, it's all U.S. dollars. All U.S. dollars. These are U.S. dollar contracts, futures contracts, priced in dollars. Aight? Mm-hmm. All right, British pound, like I said, this is before the change because we wanted to see last week, it was the middle of the week. And so this is close on Tuesday. So technically Wednesday, right? So Wednesday is the middle of the week. So this is just before we thought the British pound would go long. In this case, Look at how many people got out of their short positions. Down, 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 down. Okay. Very interesting. Was there an increase in people going long? No. So very, very little change net wise. But 1 week from now, when we do this and look at the updated report, what I want to see is that a lot of these people that went to the sidelines, because look at that's what's happening, right? Many people, many less people short, but many less people long. They're getting out of the British pound. So if or when, and I would argue that it was probably Wednesday of last week, if they get back into the market, are they going long, right? So if we can get one more dip where there's less people short but many more people long, then we have a change in trend. And we guessed it right, probably the IMF report. And then for that, I would say you're welcome. Thank you for the box of cigars. I really appreciate it. I like Cohiba Bay Hikes. Okay. They sell them in 5-packs, I think. Wink, wink, nudge, nudge. All right. Just label them as T-shirts or socks or something. Yeah, make sure you email me first. All right. So yen yen, check that out. Nice trend, huh? Okay. So yeah, no change over the short, no change over the long. So we've been neutral for about 3 weeks. And that's why we've been stuck between 118 and it's not even 118, right? 118.50 and 20.50. So we've been in 200 pip sideways range for a while, and you can see there's no change in net positions over the course of 3 weeks. So once again, if you see a dramatic jump, could be interesting. Adam says in the post, yeah, email me if you're actually going to do it. Hey, how's the trading going? How about everybody else? Last week there was quite a few people that reported, the first 500 pip trade. They had a couple of people said they had 300 pip trades open and stuff like that. You guys rocking it? Negative last week. Hey, it happens. Take the profit. Yup. 10 pips today. I'd consider that a break-even trade. Yeah, Monday can be slow. Yeah, Harry, good week last week. Couple 100. No, good. I like triple-digit, trades. Right on. That's a nice little day trade, right? Good for you, Harry. Like, real was a small loss. Demo was about breaking. Yeah, that happens. If it wasn't a big week, you're not supposed to make big money. I'm always very cautious when someone makes a lot of money and the market has been quite slow, because it's a function of risk, right? That's why professional just things like Sharpe ratios. because they want to filter out, based on risk. They're looking at risk-adjusted performance. So, like one of the things I'm studying at Harvard now is beta. And, beta, as we all know, I've always looked at it in particular as the general risk in the market, right? That's how I've always looked at it when doing measurements for performance in regards to Forex. But we're looking at it as, a stock's beta, which is essentially its risk, or as defined in another way, its volatility versus the volatility in the overall market. So if the market is just, chumming along, not many swing highs and swing lows, just moderately moving, but your trading results are like up and down, big winning days, big losing days, you have an extremely high all over the place beta, and that's risk. And professionals want to look at this. So I'm telling you, if the market hasn't produced much, and that would be a low beta, but you have big wins or big losses, it doesn't matter. You can have big wins. You know what? An investor will look at that and say, oh, you're taking on risk, and I'm not interested. Okay? It's just risk, because your alpha, your ability to beat the market, is too high in regards to the returns of the general market over the same period, measured by things like standard deviation, volatility, and such. So all these things matter, guys. Only an amateur says, "Oh, look at all the pips I made." A professional doesn't care about that. Based on what? What did you, right? Now, if the market's moving, you better make a lot of pips. But if the market's not moving, your performance should be fairly flat. Otherwise, you're doing something, the market's not giving pips, but you're doing something and you're making them, and it's usually risk. So like sometimes people will say, oh, I made a lot of money this week. Well, again, we're more interested in, you made your money, okay, fine. How'd you do it? How much risk was taken, right? Like I remember one time I was being heckled off the street in a live thing. He was like, Wayne, I'm a better trader than you. I'm the world's greatest. And I'm like, oh, well, I'm glad you had a great week. And he's like, yeah, I made like 300 pips, man. Like 300 pips. Well, the pound yen moved 1,000, just pound yen. Like, so relatively speaking, that wasn't a good trading week, dude. Like, look, you had a choice every day of, let's say, 5 different yen pairs. They all moved 1,000 each, and you only made 300. But in reverse, guys, if the market didn't do anything, if it was flat, and you made 1,000 pips, or 10% return on investment, your account's up 10% on a well, first of all, you're over leveraged, and then B, the market only moved 1%, you're up 10%. Again, you can see this becomes a problem, right? You're like, and then you find out the guy's up 10% on a flat week, and he only made 200 pips. I'm like, are you nuts? The amount of leverage, so it's all risk, and lackluster performance, right? So professionals care about these things, guys. The best way to make a lot of money in Forex is just very consistent, very boring trading. You want steady mediocrity. Every single day you make an okay amount of money, taking very little risk, and it just compounds and compounds and compounds, and your account size grows, and you reduce your lot size relative to your account size, so that over time, each trade has less and less risk per trade. You know what I mean? So someone asked, as what is good for an FX trader, and Sharpe ratios and stuff. I don't want to get into this now, but just remember that reward is a function of risk, and investors don't like risk. So something dumb would be to tell an investor you make 10% return per month. And they're like, okay, well, I'm not interested. And you're like, but I make all this money. And they're like, well, no, you take all this risk, and I don't want you to risk my money. So if you look at the CTA index for currency trades, the best of the best make maybe 2% a month. They're the best of the best. 2% a month. Obviously, they're not taking big risk, but providing steady returns. And now an investor can say, I know what you do. I like your returns. You don't take too much risk. I know how you fit in my portfolio. I have a spot for some of our risk capital to be, allocated toward alternative investments like a currency fund. Also, some clients are exposed to foreign currencies in their small businesses, so we'd like to add a currency fund to our portfolio. So looking at your risk-adjusted performance and your track history over the last 3 years, we know that we can take a certain part of our portfolio, a certain percentage, and allocate it toward you, and that you would fit within our risk-adjusted return, tolerance. And all that says is they can plan. Right? Money management is about planning and planning ahead and knowing what you're getting into. And knowing how you fit into a balanced portfolio. Right? Not making a bunch of money. So, anyways, how did we get on that? Aussie dollar. Flat on the long positions, a lot less people short. So what's happening at 75, guys? Is it reversing? We bounced at 75. According to this, is it a total reversal of trend? Nobody on the planet is buying the Aussie dollar. As of Tuesday of last week, nobody was longing it at 75. But a ton of people have been getting out near 75. Getting out, they're taking profit. Okay, so I say I'm still bearish on the Aussie dollar. Okay, and this would confirm that analysis. So someone did ask more about Sharpe ratios and stuff, and probably interested in Sortino ratios and other risk-adjusted performance measures. How many people are interested in like advanced portfolio management type topics? Yeah. And why is that? Are you at the point where you're raising money? Or is it just something that you're interested to measure your own performance? Or, you're talking pretty high level stuff that, you're not getting this at very many places, right? So tell me, guys, if you were interested in a stock, okay, if you're interested in a stock, how much is it going to be worth? How do you value a stock? The efficient market hypotheses would say that the stock is the present value of all future cash flows based on dividends. Does that sound complicated? Like, what kind of person came up with that? Oops. And I'm like, that's not right. But that's what people are taught. Really? The present value of future dividend cash flows? You know, I'll show you how fun these things get, because you're like, teach me about like Sharpe ratio. You're like, I hope you understand it's all math. So the expected, you know what, and then we'll go back, I promise you. But you guys are interested in this stuff, so let's try this. Okay. The expected return of a stock is equal to the risk-free rate of return plus the stock beta times the expected earnings, hang on, of the market. Oh, expected return. So R sub M minus the risk-free rate of return, which okay. Okay, so that's basic stuff, right? The expected return for a stock is equal to the risk-free rate of return plus the beta of the stock times the expected return for the market minus the risk-free rate of return. CAPM, thank you. So, you know, this is where your risk-free rate of return, you might look at like a 90-day T-bill, a one-year note or something like that. And the beta, you know, you can do various calculations and figure out the beta, but again, the beta is this particular stock's volatility over the market. And the market, you have to take, you know, your expected return. So you might say scenario one, the stock market is up 1% next year. In situation two, it's up 10% next year, right? And maybe that's all you do. So you might do a couple of these things. And your risk-free rate of return would be the yield on the one-year note. So let's just say, you know, I don't know, 1%, whatever that is. You know, and then the beta is available too. And, you know, and so you just figure that out, and that'll tell you exactly what a stock is worth. And Sharpe ratio is the same thing, well, not the same thing, but the idea is, okay, you know, you should be able to revalue your performance based on the amount of risk that you've taken, based on things like standard deviation from the market. So again, let's say the Euro USD is down 5% for the year, so you were selling Euro USD, right? But it's down 10%, and you've made 50%. So, you know, how did you outperform the market by so much? And people could, well, say, well, leverage and stuff like that, right? And, well, maybe you took a lot more leverage than somebody feels comfortable with in their particular portfolio, and they're like, I like the return money-wise that you got, but you got that based on the amount of leverage you took, and that's why you outperform the market. So even though your results are good, I'm not interested in investing based on risk-adjusted performance analysis of your returns. Okay. Easy stuff, right? Okay. Child's play. Yeah, cool. So anyways, Kiwi. Look at the dramatic drop in people short. Just huge. Look at the dramatic increase in people long. Therefore, the little black line, just huge interest in buying this. Fantastic demand for Kiwi. People want to catch that yield. Awesome. Very good. Very, very nice stuff. Very, very bullish. And how about our kitty cat? Very little change. Sideways, but we're in a sideways range, right? So, not surprising. We did break out of the range. It'll be interesting to see what happened at the next traders report. Oops, clicked on the wrong one. Hang on. Let's take a quick look around the world and then we'll wrap up today. Fernando, where'd you learn CAPM? It's a capital asset pricing model that I just did. You do analyst work? This is going to be the USD CAD stuff, guys. So we did have a breakout. So if you think this is going to continue, the way you'd play it is up and then down. So your sell zone would be here. You guys learned that in university, just finance stuff? Yeah. How long ago did you learn it? I heard it 1943. But just like, are you a student now kind of thing? Or, yeah, 10 years ago, yeah. Have you used it ever since? You're just like, oh yeah, CAPM like every day. It's amazing that this is the stuff that's taught, and I'm like, you know what, the market doesn't work that way at all. Why do you teach this stuff? Oh, I don't know. But anyways, so that's kitty cat. So that could be a breakout. So we might want to sell the rally up into there. That's your call. Okay, and let's check out our buy zone on the DAX. Do you guys like buying the German stock market? Let's see what happened today. Oh, snap! Right off my buy zone from non-farm payroll. Not payrolls, just Friday at FX Street. Did you guys attend the live strategy session at FX Street on Friday? Remember, I do it Fridays at FX Street. Every other day it's here at TradersWay.com. Yeah. So this was one where we're like, there was a couple of places to buy the dip on the DAX. That was one of them. Right? You don't have to be a rocket surgeon. Igor's going to short up the top. Sweet. Just remember, you're shorting against the ECB's purchasing program, right? Like they're pumping free money into the market. So don't trade it like a typical market. That market is manipulated. Right? It's, a strong uptrend. It's not even that. It's all artificial. The ECB is pumping billions of dollars, and that's that. There's nothing right or wrong about it. It's just up. So if you're going to be shorting against that, just be very careful. I certainly wouldn't if I were me. Okay. So you notice we got our 50% retracement and boom, we're up here. If you're a bear on the US stock market, that would be sort of the area that you would want, M3 to M1. You see that, guys? M3 to M1 if you're a bear, and that would be a lower high, lower low scenario. Now, this might be just like what Igor said about shorting the DAX. The only thing is the Fed is not pumping billions and millions of dollars into this market, like the ECB is pumping billions of dollars into the other market. So, you know, I'd rather wait to long the DAX. And if you're going to short the S&P 500, that's your alpha, baby. Just make a decision, right? Therefore, you'd play the pivot, M3 to M1, and that would be your week. So basically, work our way back down to the old buy zone. And when we're down there, or if we're down there, I would buy that. Of course, as a bull, buying at the 50% is pretty good too. Okay. So again, the real decision is just making a decision. 50% up to the 1618. We've hit our target. That's it. I don't got anything else on that one. Does that mean short? No, not really. So look out on oil and see what else is going on. The next sell zone is up here at 64. So 64, 65. Now 65, based on this move, just happens to be the 2618. So I'm cool with that. So if it goes up, it's probably going to go like this. Let me do some guessing here. You are not alone. I am here with you. Do 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 do. Do 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 do. All right, how about that? So Fernando says looks at the Sharpe ratio. Yeah, so you don't want anything crazy there. Information ratio and beta. Yeah. Does anyone honestly believe that the stock price is set based on the present value of future cash flows? Like, why do they teach that? Like, it just can't be. So then you argue like, well, most stocks don't pay dividends anymore. Like, oh, well, but it's priced on the assumption that dividends will be paid in the future. Like, are you stupid or something? This is why you never hire an MBA. You've been brainwashed. All right. So anyways, yeah, all right. This is looking interesting. You can see the thought process here. I'm still thinking down, but right now it's been sideways. Yeah, Igor, another good thing. Huh? So you can see here we got a pull back and a drop, but it just didn't produce. So this is just moving sideways. All right, and so you know we'll just continue with the technical analysis, I guess, tomorrow. Remember, keep your focus on the Aussie and the pound this week. Should be very interesting. I'll be here tomorrow, 7:30 in the morning, New York time, London lunch, to help you go through. Maybe we'll do some swing trading tomorrow. What do you stink? Smell like a plan? Cool. Hey, Thank you for being a client of TradersWay. We appreciate that. It's really good to see you logging in every day. I hope it helps. Yeah. If you're watching the video on YouTube or something, please give it a like, a thumbs up. Even better, leave a comment. Peace on earth. May the pip be with you. May your profits be above average. Cheers. By the way, just another thing you do is I'll drop you on YouTube right now. You can find one of the old videos. Leave a like and a comment there. Huh? Cheers.